Welcome to Edison TV. I'm Catherine Thompson, Technology Analyst at Edison, and I'm here today with James Barham, CEO of PCI-PAL. PCI-PAL is an AIM-listed global cloud provider of secure payment solutions for business communications. Welcome, James.
Hi, Catherine.
To kick off, could you give us a brief overview of the company?
Yeah, sure. So PCI-PAL is a SaaS technology company. Everything we do is in the cloud. In Amazon Web Services mainly for us. We're around 19.5 million ARR today, fast growing business, compound annual revenue growth in the region of 25% for the last 5 years in a row, so real growth company. We operate in the business communication space. Primarily our customers use our solutions in contact centers, which were previously known as call centers, but they do a lot more than just handle calls today. And we help those organizations to facilitate payments, so transactions that they carry out with their customers. We also help them secure that data when it happens. And we do that in a way that's completely integrated to the entire environment that they're operating within. So we integrate tightly into the communications environment, particularly that part, the CRM, the desktop, and also the payment area as well within that. In terms of our go-to-market model, which is fairly unique, or it's a real strength of ours, we sell predominantly through the channel. So we've got a very strong partner ecosystem that we talk to investors a lot about. We're very proud of that. It's been a key part of our strategy since very early on. And about 70 to 80% of our new business sales come through that partner ecosystem. And the partner ecosystem consists of lots of different types of companies that cover those sort of three environments that I just talked about, but particularly the communication space. So we're very tightly integrated to business communications platforms, CCaaS and UCaaS, so buzzwords, contact center as a service, unified communications as a service, and productized with those organizations, sorts of companies we're talking about here. Many of them are US headquartered, multi-billion-dollar organizations like Genesys, RingCentral, Zoom, these sorts of organizations. And PCI-PAL is often the preferred provider to those companies, and we put in a lot of effort to reach that kind of status that we have. And yeah, we're at a really exciting time with the business, and we've got a good update going out shortly.
So you've just announced your year-end trading update, and alongside that you've put out your new 3-year strategic plan. If we just start with the trading update, could you give us the highlights from that?
Yep. So good year for the business. Really happy with the performance. In terms of growth with PCI-PAL, we tend to focus predominantly on ARR. And our ARR growth organically is 25% year on year. So really happy with those sorts of growth levels. We are the fastest growing company in our market. It's a fairly niche market, quite specialist, but we are the fastest growing. But when we look at peer groups on AIM, etc., I think we're in a good place in terms of ARR growth. We also consider a metric called CAR, which is contracted annual recurring revenue. Those that know us will notice the rebrand there. That metric we used to refer to as TACV, so total annual contract value. The difference between CAR and ARR is effectively that CAR has included within it contracts that are not yet at revenue recognition. So CAR at the 22.2 million it came in at is a really good future indicator of what recurring revenue is going to look like 6 to 12 months down the track. So we've got a good line of sight of that coming through. In terms of top line revenue, group revenue, and what's in the market forecasts, we've reached expectations in the year for top line revenue that we've recognised across the group, and adjusted profit before tax as well at just south of $1 million, which is very much in line with the plans for the year. Outside of those kind of key sort of financial metrics, the customer retention continues to be very strong within the business. So our gross revenue retention up at north of 95%. We're consistently between 95, 96, 97%. So very sticky customers. Probably most encouraging for me when we look at operational metrics within the business is the net revenue retention that we've reported. which we've seen an increase from 102% last year to 104%. And actually, I've talked to investors a number of times. Given our strong retention that we have, I see a big opportunity with NRR for this business. And how do you drive NRR up further? If you've got strong retention rates, you need to sell more to your existing customers. So either expansion sales or cross sales that we're making. And predominantly in the past, most of our additional sales that we make to existing customers are expansionary sales. But with the evolution of our product roadmap and broadening of the value proposition that we've got, we do expect that over the next 3 years, we'll be able to see a steady increase in that NRR going up, which will drive further long-term value to shareholders.
And that leads us neatly into the 3-year strategic plan that you've talked about in this release. Can you give us a bit more detail on the motivations behind that, kind of what growth expectations you have, and what it also means for your profitability and cash flow?
Yeah, so if you let me scene set a little bit there. If you look back at PCI-PAL's history, prior to starting this year, for 3 years, we were battling patent litigation with a competitor of ours. There's a whole load of history there, but we won, in short. But we settled what remained of the case, having won in the courts in the UK in just June last year, actually. And that was a big burden on the business, both cash drain, real distraction for management as well. And so when we came into this financial year, the plan was to carry out a full review of that rolling 3-year strategy that we've got. And then around that time as well, we also went through a transition of CFO. So I had a new CFO, Ryan Murray, join me in just October time. So actually, by the time we'd come out of the patent case, we'd hired the new CFO. We were really getting to the end of our H1. And so when I was seeing investors through the year, I was talking to them about our plans for the full refresh of the 3-year plan. In fact, I didn't really need to tell them, because many of them were saying, right, now you've got that monkey off your back. What's next? Where are we going next? And so, that came into play when we're considering the growth objectives for the business. Now, we have cash in the bank, and, we take a prudent view on that. We don't want to go back to a position where we're perceived to not have enough cash. But also we want to move quickly. In any SaaS market out there, you can't stand still. We feel that what we've achieved to date has been a real success, and we think there's more that we can do. 2 of our major competitors are in private hands now. And so we can assume that the market's going to move quickly, and we need to move quickly as well. And so, having reviewed those plans, we've made a decision that we want to invest further in the business. I would say a fairly prudent investment in the business, around the level of around 1.5 million in cash investment out of that effectively 4 million that we have at the end of the year. We actually anticipate across FY26, when we're going to spend most of that cash, that will be borderline cash flow neutral. Okay. So we think, from a risk perspective, we think it's a very calculated one to do that. We've got super high customer retention. We're not going to lose our customers overnight. And we think that's a good use of those funds for investors. And we think we could really see value from that over the next 3 years. And particularly important to us is that we keep growing that ARR organically. And how can we do that in the region of 18 to 20% year on year, not just in FY26, but 27, and we're looking beyond that too. And to achieve that organically, I remember the days not that long ago when 7-8 million revenue. It's a lot easier to grow revenue by 50-60%. Once you start hitting 25 million in revenues, then it does become more challenging. And so keeping revenue growth at those sorts of levels does require investment, and it requires pace. And there's an element at play here where during that patent case and that 3 years of a 4 million cash drain that we had to pull some things back in as well. So to a degree, there is some, I'm not sure if catch up is the right term, but really getting fully back on the front foot is what we want to do. And in terms of how we're using those funds, marketing is actually quite a big part of that. And I've spoken to our investors about the fact that we publicly said we reined our marketing spend in during that 3 years, and we're looking to sort of re-accelerate that. We've kept our marketing spend relatively flat for the last 3 years, which is highly unusual for a fast-growing business that tracks, marketing to ARR. The ARR has been going up, but the marketing hasn't. So proportionally, it's low. And the exciting thing about that is that that's opportunity. I'm not talking about spending money to correct problems. I'm talking about spending money to drive sustained growth, to create more opportunities for the business, to get new product to market quicker. And so there is an element of that investment as well that goes into the engineering side of the business, but predominantly it's the marketing and product marketing side. And as I say, cash about 1.5 million. It's about 2/3 of that would actually impact the FY26 P&L.
So touching on product again, so how do you adapt to changes in customer behaviour and also payments technology? So for example, people using more self-service payment channels, interacting with chatbots, making more non-card payments. How does that inform your product roadmap?
So for a number of years now, we've been releasing enhancements to our core key to pay, click to pay and speed to pay offerings. So for a number of years now, those solutions have been used with not just credit and debit card payments, but numerous different types of digital payments. So very common for our click to pay solution, for instance, take payments via Google Pay or Apple Pay. We have customers using open banking payment methods as well. So we've been evolving that anyway. And actually by doing that, we've been bringing those kind of e-commerce type digital payments to contact center environments for the first time. And so, to a degree, we've been doing that anyway, and it's been informing the roadmap for quite a long time. PCI-PAL's original value proposition was very focused on compliance and security. But in line with what we've been doing with the product roadmap, we also facilitate payments. We're often the party that is actually making a payment possible. So we're making that transaction between that merchant company and that consumer possible across that web chat session or across that social media interaction with that chatbot, with that voice bot that we're now starting to do as well. And we do that in such a way, as I said at the very beginning with my intro, that is nicely and tightly integrated to that environment within which it exists, which operationally is super important for companies that run contact centers. So we can do it in such a way that makes sure that all the data reporting is reconciled to the right place, that the CRM is updated, that information to the business communications platform is updated as well. So we're already providing a level of value across that. Now, in terms of the product roadmap, I would say that the first question on many investors' lips, but also the big kind of change that is coming into all of our worlds, whether it be at work or at home, but within contact centers as well, is AI. And in particular in our space, the terminology is conversational AI. And conversational AI is effectively voice bots and chatbots. And the very plain message from PCI-PAL, but it's definitely not the complete message, is that we don't care whether it's a human agent or whether it's a bot. We carry the same value proposition for either, potentially. And so across the year that we've been working, we already work with a number of conversational AI vendors. There are hundreds of them cropping up all over the place at the moment. So actually selecting the ones you want to work with is part of the challenge. And actually, we've tended to focus our efforts on conversational AI with where our partners are going. The CCaaS platforms are facilitating a lot of these interactions across the global contact center solutions market, and we're seriously well positioned with those organizations. And so we've been integrating with our partners conversational AI products, with third-party conversational AI products that they have partnered with themselves. And we've got numerous customers out there now that are using PCI-PAL solutions, both for speech recognition payments with voice bots, but also through digital payments, so text and chat bots, effectively. And so the conversational AI piece is quite interesting. It's one where we think that we're in a very strong position with. It's happening slower than perhaps some would anticipate. There are very few payments going through conversational AI platforms today, is our view. I say that quite cautiously because I think there's when new technology comes into a market, it's easy to say, well, it'll always take longer than everyone thinks. I think AI is a bit different. But we are fully immersing ourselves in the direction of travel that is taking. We're completely integrated to the majority of those CCaaS markets who are facilitating a lot of those conversations, whether they be human or bots. So we're really well positioned to be part of that. And we're making ourselves really easy to work with on the technology side of things so that these conversational AI platforms can work with PCI-PAL. So look, the contact center market, I think we've referenced it in the trading update, is set to grow by, the solutions market around it is set to grow by 6 to 7 times over the next 8 years. A part of that will be conversational AI interactions. And we fully intend to be part of that. And we believe strongly that our value proposition is pretty much the same for a conversational AI vendor as it is for a CCaaS vendor today. And if we had more time, we could talk into the detail of, specifically why that is. But that's our view.
Okay. And actually talking about the partner channel, the majority of your contracts and contracts by value and number are won through your channel partners. Are there any other kind of large vendors out there that you still want to sign up? And can you also give us an update on some of the more recent partners that you signed up? So, for example, RingCentral and Zoom.
Mm-hmm. Yeah, so we've been very successful in building our partner ecosystem. We've been super targeted about it. It's been very purposeful. We've built our whole business with a strong focus on channel, right down to the people we hire in the business. It's ingrained in everything we do. And I think that's important. It's been an important part of our success. What that has meant is that we already work with a lot of the key players in this space internationally. And so, when I talk to the business, the first point we're normally thinking about is not who's the next partner we're going to sign, but it's what do our relationships look like with our existing partners? What more can we do with our existing partners? These organizations, many of them are very large, they're 5,000-10,000 plus employees across numerous different countries. And to a degree with many of them, we're just scratching the surface. So that's kind of the starting point before we go running off signing more partners. It's easy to sign a reseller agreement, frankly. It's more about actually enabling that partner, being productized, onboarding the partner, sales enablement, et cetera, and everything that goes with it. We have targets, though, going into the year. We think carefully about who those organizations are, how we're going to get into those organizations, where the best place to do that is. We have some relationships on the CCaaS side, which are not full OEM type reseller relationships yet. None of the ones I've mentioned, they're all resale, but there's one or two others on there. And we fully intend to move to a different sort of categorization of partnership with those organizations. And then you've got some new partners coming through. We referenced in the trading update, we signed RingCentral in the year, which we'd already announced, but we're seeing some great momentum there. Looks like a really good partnership for us. We've also signed another new $1 billion revenue US headquartered corporation who's in the business communication space. They've recently launched a CCaaS product to go with their established UCaaS and meetings product set that they've got. So we've been successful in signing them there. So we have a pipeline with new partnerships in there, and we think carefully about it. Some of those will be related to existing relationships that we've got and expanding those or getting a better level of commercial contracts in place with them. But then there are others in there that are completely net new. And particularly we are looking at organizations who are strong in the business communications and contact center space. And just to be super clear on the contact center point, that includes conversational AI. So when we talk about contact centers today, that's humans and bots. It's the same thing.
And kind of last but not least, what's your direct sales strategy?
So our direct sales strategy actually feeds our channel strategy as well. So a lot of the time with our direct sales strategy, direct marketing strategy, if you like, we're actually marketing to our partners' customers as well. So our kind of default position is that we'll normally try to fulfill opportunities as they come through directly through our partner ecosystem. That is the way to run a healthy channel business. And because we've got such an extensive partner ecosystem covering so many of the CCaaS vendors that are out there, more often than not, we're able to actually do that. And then that's to the benefit of that relationship. Where we are signing kind of net new direct business, it tends to be more larger contracts because it will be organizations who want to deal directly with the supplier. And that tends to be more suited to large central government or large enterprise type organizations. Our two of our largest customers who in the UK are HMRC, who we all know very well, and the Department for Work and Pensions as well, who in the year we re-tendered and successfully won that contract, but that was won direct. And so, these sorts of organizations like to work directly with PCI-PAL. Now, thinking about the strategic plan going forwards, the investment that we'll be making in marketing, an element of that will be looking to light a fire under our account-based marketing strategy. So, how do we attract more of these enterprise businesses? As I say, we're quite happy to fulfill them through partners, but we want to get ourselves in front of more of those organizations because we've done very well at scaling the business on kind of mid-market size business, and the majority of the contact center market is small to mid-market. So that's the breadth. That's the majority of the market that's out there. But we recognize that if we can sign more of these enterprise customers, which it's become a real strength of ours over the last few years, if we can sign more of those, then it does kind of supercharge that ARR uplift and maybe make life a little bit easier for us to a degree. And so very much it's focused on ABM, account-based marketing, and enterprise strategy. But at the same time, it does complement what we're doing with channel partners.
And finally, to wrap up, what KPIs should investors look to track how the business is doing?
Yeah, so mainly the KPIs that I've talked about already. So ARR and CAR. The reason we changed the name for that, by the way, is that the gap is closing between CAR and ARR. So, it's not around the corner, but the day is coming where that gap will be so close, at some point in the years to come, where actually we think that that's more the metric that the business should be valued on longer term. And that's more traditional SaaS. And that's one of the reasons we changed the name of it, was because we wanted to have a direct and clear correlation to ARR, which is effectively, what it is. So ARR and CAR, clearly very important. You then have those operational metrics around our retention and our ability to cross-sell and expansion sell to our existing customers. So of gross revenue retention and net revenue retention. Rather than talk about profitability next, talk about cash. So, using our cash efficiently balanced with the growth opportunity that we've got. I talked about the fact that we do actually expect to be cash flow neutral in this year of investment that we've got coming in front of us. And I know that will be important for investors. And then we believe over time, we can start to see us get to a position where we can start to generate much more positive cash flow into the business that then can potentially create more opportunities for us down the track. And then outside of that, it's not one we report publicly as such, but we think about Rule of 40 within the business. Rule of 40 is more challenging when you're a growing business and you're investing for growth. And there's some other metrics out there like Rule of X, etc., that you can use. But Rule of 40 is certainly something we look at as an internal metric, and we're particularly looking at that when we're looking at long term where the business is going to get to. And I think, after this next 3 years, that's where Rule of 40 really kicks in for us. And that's where we think we'll be able to get to a Rule of 40 company. But, who knows what opportunities are going to come our way, quarter to quarter, year to year, as we go. But yeah, I would say they're the main metrics.
Okay. Well, thank you very much for coming in.
Thanks for having me.